Forget everything you think you know about buying the dip. Silver just completed a move that has never happened in modern market history. A vertical climb to triple digits followed by a 35% flash crash that reset the gold to silver ratio to 2012 levels. Most investors are panicking because they see the red candles, but the smart money is looking at the Shanghai inventory collapse and the 67 million ounce deficit that hasn't moved an inch. Today I'm going to show you why the January massacre was a necessary reset and why the next 90 days are a once-in-a-generation window before the physical supply truly runs dry. Wednesday, February 18th, New York time. Drop your date in the comments below. I want to see exactly where you're watching from. And if this kind of analysis adds value to your day, hit subscribe and comment George Williams. It genuinely helps more than you know. Let's get into this properly because there is a lot of noise out there right now and very little signal. Silver is sitting at around $75.90 per ounce as of this morning. That sounds fine until you remember that just 3 weeks ago, on January 29th, it was trading above $121 per ounce, an all-time record high. What happened between then and now is one of the most dramatic collapses in commodity market history, and it did not happen randomly. There were causes, there were triggers, and understanding those causes is the only way to figure out what silver does from here. So let's rewind. Silver had an absolutely extraordinary 2025. The metal started the year around $29 per ounce and closed it out around $79, up more than 146% for the full year. That kind of performance doesn't happen quietly, and it didn't. By December, silver was being talked about the same way GameStop was being talked about in early 2021, with retail traders, Reddit communities, and social media influencers all piling in, convinced the move had no ceiling. Robert Kiyosaki was posting on social media that silver breaking $80 meant $200 was next. The Shanghai Gold Exchange was showing premiums over London prices that hit levels never seen on record. CFTC data showed net speculative long positions on COMEX silver futures above 60,000 contracts, near 5-year highs. And the iShares Silver ETF, ticker SLV, saw more than $40 billion in trading volume on a single Friday in late January, more than Apple and Amazon combined that day. That is not a market driven by fundamentals. That is a market driven by momentum, emotion, and leverage. And then it broke. The immediate catalyst was a combination of things hitting at the same time. CME Group raised margin requirements on silver futures to $25,000 per contract, effective December 29th, in response to the volatility. That forced smaller traders, the ones trading with borrowed money, to either put up more cash or get out. Most of them got out. As prices started to slip, Goldman Sachs described it precisely. Dealer hedging flipped from buying into strength to selling into weakness. Stop losses were triggered, and losses cascaded through the system. Silver fell nearly 30% in a single session at its worst point, the biggest one-day decline since 1980. Then it tried to bounce. Then it fell again. By early February, spot silver had dropped 16% in a single day, touching lows near $64 per ounce at the bottom of the panic. The London market, which Goldman specifically flagged as having tighter liquidity than New York, made it all worse. Thin markets and big sell orders create outsized price swings in both directions. The metal has since bounced back toward the $74 to $76 range, but it remains roughly 37% below that January all-time high. Now here's where it gets important, because beneath all the speculative drama, there are real fundamental questions about silver's value that investors need to answer before they decide what to do next. And the picture is genuinely complicated. Start with industrial demand, because silver is unlike gold in one critical way. More than half of all global silver demand comes from industrial applications. Solar panels, electric vehicles, semiconductors, electronics. These are not speculative categories. These are growth sectors. The Silver Institute's data shows solar manufacturing alone accounts for roughly 15% of all global silver demand. And that number has been rising for years because silver paste is used in photovoltaic cells, and there is currently no cheaper alternative that performs at the same level. EV manufacturing uses silver in electrical contacts, sensors, and charging systems. Semiconductor fabrication uses it for bonding and conductivity. These are real structural demand drivers, and they are not going away. But here is the complication. At $120 per ounce, industrial buyers start doing the math differently. Bloomberg reported this month that LONGi Green Energy, one of the largest solar cell manufacturers in China, has already begun exploring base metal substitutes for silver in their production process. When the price of a raw material doubles and then doubles again, manufacturers do not sit still. They find alternatives. They redesign products. They reduce the silver content per unit. Bank of America flagged this exact risk in their analysis of the sell-off, noting that elevated prices will structurally reduce industrial demand over time. So you have this unusual situation where silver's industrial demand story is genuinely bullish for the long term, but the price getting too far ahead of itself actually creates the conditions for demand destruction in the near term. That is one of the reasons B of A estimated silver's fair value somewhere in the $60 to $70 per ounce range. Not because the metal lacks utility, but because at speculative highs, it prices itself out of the very use cases that justify owning it. Now layer on the macro picture. The Federal Reserve is the dominant force behind all precious metal prices, and right now the Fed is in a complicated position. Core inflation is still running hotter than the Fed's target, even as headline CPI has shown some softening. That means rate cut expectations keep getting pushed back. Markets are currently pricing in roughly 60 basis points of Fed easing by year-end. But that could easily shift depending on the PCE inflation data due later this month, which analysts are flagging as the next potential flashpoint for silver. If PCE comes in hotter than expected, the rate cut narrative gets further delayed, the dollar stays firm, and silver faces renewed selling pressure. If PCE cools, there is some modest relief, but analysts are cautioning that even a soft PCE print is unlikely to be enough to restart a sustained bull run when the market is still digesting the speculative hangover from January. Then there is the Kevin Warsh factor. Trump's nomination of Warsh as the next Federal Reserve chair was specifically cited by multiple analysts as a trigger for the initial metal sell-off. Warsh is historically hawkish on inflation, meaning he is associated with keeping rates higher for longer, and markets interpreted his likely appointment as a signal that the era of easy monetary policy is going to stay closed. A hawkish Fed is not a great environment for non-yielding assets like silver. The gold-to-silver ratio right now is sitting at approximately 64.81, meaning it takes about 64.81 ounces of silver to buy 1 ounce of gold. Historically, a ratio above 80 has often been interpreted as silver being undervalued relative to gold, and a ratio below 50 has suggested the opposite. At 64, the ratio is in a neutral zone. It is not screaming buy silver, but it is also not flashing extreme overvaluation the way it was when silver hit $121 and the ratio briefly dropped toward the low 40s. Long-term investors who use the ratio as a framework will note that this current level is historically reasonable, which at minimum suggests the panic phase of the sell-off has corrected much of the speculative excess. History is actually quite instructive here, and it is worth spending a moment on it. We have seen sharp silver sell-offs before. In 2008, silver collapsed from around $20 to $9 during the financial crisis, a 55% decline, and then spent the next 3 years recovering before hitting record highs around $50 in 2011. In 2011, after that peak, silver crashed nearly 50% in just 4 months. In 2020, silver fell roughly 35% in a matter of weeks during the COVID crash, then went on to nearly double over the following year. In 2022, silver dropped from around $26 to $18 as the Fed began its most aggressive hiking cycle in decades. The consistent pattern across all of these episodes. The sharpest part of the decline is usually front-loaded. The bottoming process takes longer than people expect, and the recoveries, when they come, are often substantial. But the timing is never clean. There is always a period of painful consolidation between the crash and the recovery that shakes out the last of the impatient money. So what actually happens from here? There are 3 realistic scenarios. The bearish case has silver continuing to drift lower into the $55 to $65 range over the next several months. This scenario unfolds if PCE comes in hot, if the Fed signals no cuts in 2026, if the dollar continues to strengthen, and if industrial buyers in the solar and EV sectors begin to meaningfully reduce their silver consumption in response to elevated prices. UBS flagged that at current volatility levels, the metal would need to fall further to offer the kind of expected returns that justify the risk. A move into the high 50s would not be a market failure. It would be a return to the price range that B of A and others consider closer to fundamental fair value. The neutral case, which looks like the most likely near-term outcome based on current positioning, has silver grinding sideways between $65 and $85 for the next few months. The speculative excess has already been largely flushed out. The COMEX long positioning has collapsed from record highs. ETF outflows have stabilized. The macro picture is murky but not catastrophic. In this scenario, silver finds a floor in the current range, trades without conviction in either direction through the first half of the year, and waits for a clearer signal from the Fed or from industrial demand data. The bullish case. And this is genuinely possible, especially for patient investors with a 12 to 24-month horizon, has silver recovering back toward the $90 to $100 range by late 2026 or into 2027. This scenario requires the Fed to actually begin cutting rates in a meaningful way, the dollar to weaken, and industrial demand, particularly from solar, which shows no signs of long-term slowdown in deployment, to re-accelerate after the speculative inventory digestion period ends. UBS itself forecasted spot silver returning to $100 by next month, though they acknowledged significant downside risk before that level. The structural argument here is compelling. Silver supply from mining is constrained, green energy transition demand is a decade-long trend, and the market has just reset from one of the most extreme, speculative overextensions in commodity history. That kind of reset often creates value for those willing to be patient. Here is what you need to take away from all of this. Silver did not crash because the fundamental story for the metal broke down. It crashed because the market got too far ahead of that story. Leverage built up to dangerous levels, and when the unwind started, there was no floor, just a cascade of forced selling into thin liquidity. That kind of crash is violent and it is scary, but it is also historically not the end. What comes next depends heavily on the Fed, on inflation data, and on whether industrial demand holds up at current prices or begins to shift toward substitution. None of those answers are fully clear right now, which is exactly why patience and position sizing matter more than conviction in a market like this one. This channel is going to keep tracking silver, gold, and the macro forces behind both, with the freshest data available, not 6-month-old analysis dressed up as insight. If that is the kind of coverage that helps you think more clearly about where your money is going, you know what to do.